So to start with, as far as the macro is concerned, look, Dr. Pant, correct me if I'm wrong, but I think we are going to get a positive deflator after a number of years, and which would of course mean that the nominal, which shrunk last year, is actually going to expand. And two things. One is, what is the sustainability of this deflator? Where do you see this, while you've projected for, I think, the next year, where do you see that going for the next couple of years?
Average WPI deflation in the second quarter of this fiscal was 4.5%. That had resulted in entire GDP nominal growing at a rate lower than the real. After that, the deflation is still there, but that is subsiding. Now, Jan was again a month where we were initially expecting it to turn positive, but again the second round of collapse of global crude prices, leading to Indian crude oil basket at $28.35 a barrel, lowest since November 2003 in dollar terms and May 2005 in rupee term. So we are expecting now this to be in the positive territory in the month of February. Going forward, next year, our forecast suggests the WPI will be growing at around 2.5%. That will lead to the nominal GDP growth coming somewhere closer to what we had witnessed in FY15, closer to 11%. So we believe the inflation will inch up, it will remain benign, and what the Indian economy, not only the Indian economy, but the global economy needs, a phase of benign inflation, not the deflation, because what deflation is doing, it is affecting the balance sheet of both corporates as well as of the government.
As the nominal growth picks up, thanks to the headwinds, thanks to the tailwinds from the deflator, does that do some good to the corporate balance sheets?
I think the challenge that I foresee in this, the inflation numbers, I'm sure they would turn positive at some stage from a WPI perspective. I think it's clearly in terms of the bargaining power of corporates. And given that what we are seeing on a global basis as far as the deflationary environment is concerned, and the fact that a lot of corporates probably are operating at not necessarily the most optimal capacity utilization, I think the concern that invariably comes in is, would they still have the pricing power to pass on some of these price increases to the consumer? And that is where I think our belief is probably that will take some time. So while there is a certain amount of correlation that exists between nominal GDP and, say, EBITDA growth or even revenues per se, it's obviously not a one-on-one correlation. So it moves maybe in the same direction in some sense, but not to the same extent. And which is where I think while the WPI may increase over the next few quarters, my belief is that probably realistically you may not still see the kind of growth in the top line and the bottom line given the overall environment. The other issue was that the pillars to support this growth also don't seem to be too strong at this moment, especially at least for the next 12 to 18 months. So whether it's looking at exports, investment, consumption to a certain extent, and maybe even the government's role in the whole scheme of things. So yes, maybe over a period of time, you may see a lot of benefits coming from inflation picking up, all these maybe turning around in a more favorable way. But it's clearly for the next 12 to 18 months, I think probably I do see challenges in the nominal growth actually moving into double digit just because probably inflation moves up on account of that.
Okay, Devendra, back to the government. Everybody obviously expects the government to play a major role in kickstarting the investment. That's probably because they're the only ones with cash with them. And consumption is unlikely to be any major kickstarter as far as the nominal GDP is concerned. The question is, what is the government's capacity to do anything meaningful? They're obviously moving on a path of fiscal prudence. Do they have headroom, you think, to expand any expectation?
The government has a very, very limited fiscal space. So whatever, if they are thinking about kickstarting the investment, they have to do a reprioritization of the expenditure. No doubt, the collapse of commodity prices have given them some fiscal space whereby the subsidies are going down. At the same time, some of the steps taken in the form of direct benefit transfers and other schemes are reducing some leakage in the subsidy. But the fiscal space is very, very limited because next year we are staring at pay commission impact, which according to our calculation, even netting out what the benefit they will get from in the form of income tax and increased excise consumption on the excise collection on the consumption, they are going to have a hit of roughly around 60 to 65 basis point of the GDP. In this situation, increasing government's capital expenditure by amount more than 20% will be very, very difficult. But if they are somehow able to do it, such as moving road projects on the EPC mode, who knows, there will be some more kickstart to the investment, some improvement on the corporate profile, some improvement to some sectors.
Rakesh mentioned that currency is obviously one of the vulnerabilities given the unhedged exposures. What's our house view on the currency?
If we look as on today and compare it where we were, say 2 years back, or let's increase the horizon slightly a bit, say 2009 to 2014, compare 5 countries, which is BRICS, barring US, if we look the average for 2009 to 2014 and compare it with the 15, be it the growth, be it the current account, be it the commodity dependence, be it the fiscal, be it on the current account, foreign exchange reserves and all those, India stands out among all those 5 countries. So we believe there will be temporary upheaval in the currency market. It may fluctuate. There will be volatility, day-to-day volatility, depending upon what happens in China. China, no doubt, being the second largest economy in the world, the largest export trade player, and a largest commodity consumer, has now the more impact on the global financial and economy compared to what US used to have. But we still believe, our forecast suggests that the average value of Indian currency in the fiscal year 17 is likely to depreciate around 3.6% from the average from FY16. So our estimate suggests it will average out at around 67 rupee 52 paisa a dollar between 1st April 2016 to 31st March 2017.